Good morning, everyone. Welcome to our live market outlook for Thursday, 6th of October 2011. Some more positive sentiment came into the markets after yesterday's comments by German Chancellor Angela Merkel said that Berlin was ready to recapitalize its banks if needed, and adding pledges to European Finance Minister to safeguard banks in the face of mounting concerns about Greek default. There was also a report from Financial Times this morning that the European Banking Authority, midway to a two-day crisis meeting to assess the potential hit of mass sovereign restructuring, is re-examining the strength of the regional banks. Also today, investors are focusing the Eurozone and the UK central bank policy meetings for basically hints of the future monetary easing, as these two are two top events of today, and expectations are to stay pat with the interest rates unchanged at this point, but further steps to be closely watched, especially on the press conference of President Trichet, where he usually in his speech hints the further steps of the European Central Bank. The Trichet actually is expected to prepare ground today for the pre-Christmas interest rate cut, as this will be the final policy meeting of the year, and to offer actually further protection, to offer banks further protection against the Eurozone and the worsening debt storm in the Europe. Today, the ECB is widely expected to keep rates unchanged at 1.5%, as I mentioned. But calls for a cut have grown louder in recent weeks amid signs the Eurozone economy is deteriorating further, and as Greek default fears weigh heavily on the confidence in the bloc's bank. As a result of this, the euro and basically the most of majors stayed steady after actually consolidating the recent gains and preparing for a further rally higher, especially the euro, as the initial rally from 9-month low was capped at 133.80. However, the downside remains protected for now, and the possible further extension higher is not ruled out. From the calendar, also today's release of Swiss inflation that increased more than expected. Actually, the release today is that inflation grew 0.3% in September, following the 0.3 drop in August. And on the annual basis, the Swiss CPI moved up to 0.5% in September versus 0.2% increase registered in August, and of course exceeding expectations of 0.3 growth. Further today are, apart from the central bank rate decisions, from Canada, building permits at 12:30 GMT. And also at the same time, we have the ECB press conference that should be watched closely in order to see the further steps of the European Central Bank, as Mr. Trichet usually uses the certain terminology when he's either predicting the rate cut or increase of the rates. So we'll be watching today's press conference to see what will be the next step. Likely the rate cut in the December's meeting will be the likely scenario, as many analysts agree that European Central Bank actually rushed this year and increased interest rates 2 times by 0.25% before the situation was enough supportive for such steps. Also today from US, we have weekly jobless claims at 12:30 that are expected to grow to 411,000, which is today's forecast, versus the previous week's release at 391,000 jobs. Now let's take a look on the technical outlook for the majors, As we can see, euro on the hourly chart, after bottoming at 131.45, the low of past 9 months, on the latest leg down from 136.77, or a broader down move from 139.35, and the full decline from 145.48 end of August high. Euro is currently recovering. The 38.2 Fibonacci retracement of the move from 136.77 down to 131.45 has so far been retraced, and these highs are actually capping at this point. This is also the previous high after the gap opening at 133.80. So this is the strong barrier for euro dollar at this point, and past 2 days the pair was unable to break higher. However, on the downside, 132.80 offers good support, and basically the pair is currently consolidating recent gains from 131.45, and the near-term outlook is slightly aligned to the upside, as the immediate support comes at 20 days moving average that's currently turning higher and supporting the pair, with the hourly studies above their midlines, keeping the positive near-term tone in play. Break above 133.80 is required to end this near-term recovery phase and open way for further extension higher. 134.10, we have the next 50% Fibonacci level, and the next one is 134.70, 61.8, and the previous high at 130, where are we? Previous low, at 135.18. So basically, break above 134.70, which is this 1.8%, would confirm the near-term basing at 131.45 and 135.20. The next barrier for test. On the broader play, 20 days moving average is well below the price, supporting currently the outlook, while it is still the midline, but higher. We have strong ones on the hourly chart, and the likely scenario would be break, in case of break of 133.80, for test of 134 and then 135 before the bears come back in play, as the broader outlook for euro dollar remains still firmly bearish, and it's capped at this point by trendline resistance of 139.35, currently standing at 135.50. We can see it on the hourly chart that on the daily chart that downtrend from 145.48, the high of 30th of August, is firmly in play, as the recent break below 20 days moving average below 200 days, and current attempt of 55 days through 200 days moving average, confirming the bearish tone. Her studies are in red zone, deep overextended, so we might see, as well as the RSI touching the oversold zone, we might see some stronger correction before the bears come back in play and they extend lower. Below 131.45, we have immediate support at 130.00 as the psychological level, and then comes 61.8% Fibonacci. Actually, it comes first 130.38, 61.8 Fibonacci retracement of the broader uptrend from 118.75 2010 low to 149.38 2011 high, below which opens 130 and the key medium-term support at 128.72, which is the high low of the 2011, posted on 9th of January, and is also higher low of the broader uptrend from 118.75. So on the longer term outlook, the euro dollar remains firmly bearish, with 131.45, 130.00 respectively in focus. On the near term, the scope is still seen for further extension higher, as the market currently attempting through 133.80 barrier. It's been already dented at 133.85 with firm break higher opening 134 zone. 134.10 is the 50% Fibonacci retracement. Then comes 134.60.70, the previous high of 30th of September, and 61.8% retracement ahead of 135 level. These are the levels to be watched today on euro dollar. The main support in the near term, it's 132.80 zone, and holding above here keeps this near-term positive tone in play. Loss of 132.70, 80.70 supports would weaken the near-term structure and likely signal return down to 131.45 as the broader picture remains firmly bearish. British pound was also supported at 154 zone. However, moving in the past 2 days in the consolidative range of 100 pips below between 154 and 155 on the bounce from the recent low at 153.39 posted 2 days ago. This was just ahead of the key support at 153.26, the 22nd of September low, and basically holding above 154 keeps the near-term bull tone in play. However, clearance of 155 barrier is required at this point to resume recovery, and the immediate level is Fibonacci 50% at 155.26, and then comes 155.70, 61.8%, and 155.85, the 3rd of October high. Strong barrier is at 156.64 ahead of 157.14. That was actually the limit, upside the limit of the bounce from 153.26 low of 22nd of September. And basically upside break of 57 zone would signal temporary bottom and open way for a stronger recovery of the pair. While holding below 70 negative tone in play, as we can see that our daily outlook is firmly bearish, crossing a triple death cross on the moving averages, signaling a further extension lower with the moving 20 days moving average on daily chart supporting current action lower. However, bounce higher and possible regain of 157.14 would be signaling the double bottom here and the open way for a stronger bounce of the cable. But on the longer run, below 160, 130, where the 200 days moving average currently stands, would be still bearish. The only break here is to signal end of the bear phase and the return towards 165, 167 resistance zone on the longer term. The dollar yen is again within 50 pips range as renewed attempt late yesterday. Hit 77.05 ahead of return back to 77.60, 50 support zone. There is a small, I would say, sign of a positive action in the pair, as there are a series of, even better seen on the 4-hour chart, a series of higher lows from 76.10 keep some positive tone in play. However, at this point 77 is a strong barrier and the pair is still unable to clear it. On the upside, the break above 77, 77.25, which are the two previous highs, might signal some stronger recovery. However, break above 77.85 and 78 is required to confirm this move. On the near term, the tone is again turning negative, and we have this trend line at 76.60 as immediate support, break of which would turn again near-term tone more to the downside. We can see that studies are breaking below their midlines, and this is actually on the near-term run signaling further weakness of the pair. 70 series of support 76, 60, 50, 40, and 30 ahead of 76, 10, 76, 00 as the key support on the downside are currently limiting the downside, and only break below 76 to signal further extension of the broader downtrend of dollar yen from 85.50, and this would turn very bearish, but also the possible action of the central bank is currently, Central Bank of Japan is currently limiting the downside for dollar yen. The dollar Swiss is firmly in strength again after a pullback from 92.60 high of 2 days ago, 4th of October. Found good support at 91.40.60, 45.60, which is also the one of the previous highs posted on 26th of September, and fresh strength through 92.60, the previous high. Briefly tested the 93 zone. 93.10 was seen so far. With firm break here, we are looking for a test of 93.38, which is 27th of March high, and then we have 94 level, which marks 50% Fibonacci retracement of the broader 2010-2011 down move from 117.30, which is the high of 2010, towards 70.67 low of 2011, and also the historical low for dollar Swiss. Currently, the daily outlook for dollar Swiss remains firmly bullish. However, the studies are a bit overextended with RSI already in the overbought zone. This might signal some technical corrective action before the bulls resume higher. However, it might also signal the exhaustion of the recent strength as we're approaching the key barrier of half of the move, 50% retracement. We need to see basically the break above 94 level in order to confirm the bullish action from 70.67, extend higher towards the next level is 61.8%. Actually, the first we have 97, around 97, 50, 70, and then we have 61.8% at 99.35. Basically, we are looking now on the upside for 93.38 for the short term, 93.38, 94.00, and I would say that 94 is currently the key barrier for dollar Swiss. Break here to open the fresh face higher towards 97, 99 zone. On the downside, yet support is at 91.60.40, which is our initial. However, the previous high at 88.60, 88.60 actually is our key support on the downside, and the break here would be would risk deeper correction of the pair and put the immediate bulls on hold. Commodities, I would like to start with the gold, as I was taking a deeper outlook into the yellow metal today. As we can see, the recent decline from 1920, the record high of gold, was contained at 1532, the 200 days moving average, and current bounce actually remains stuck now within 1679 and 1582 range with 38.2% retracement of the entire move, currently capping the upside. This is actually the consolidation of the recent bounce, and we need to see break above 1679 in order to signal further recovery. Also, the daily 90 days moving average currently is capping the gains. So this is our initial barrier at 1663, ahead of 1679, the previous high, and then comes 1700 as a previous strong support, current now strong resistance, ahead of the 50% half of the move Fibonacci retracement at 1725, above which would definitely signal a resumption of the end of the active pullback, the strong corrective of over nearly $400, and to focus up towards 1920 zone. On the downside, loss of 1582 would be again very bearish, and a key support at 1532 will come in focus, along with 200 days moving average, below which would weaken the medium-term structure for gold. The crude oil is again back to strength after hitting a fresh low at 74.94 2 days ago, and basically the oil futures gained more than 5% yesterday after 3 days of losses, as we can see here. Unexpectedly, yesterday's unexpectedly large drawdown in the U.S. Crude inventories, and quite strong U.S. data, triggered by also technical buying as the investors were taking profit, and basically of the longer term short positions. It's pushed the crude oil price through some important levels. The current regain of 61.8% Fibonacci retracement of a move down from 83.95 down to 74.94 at 80.75 signals further strength of the oil, as 81.11 was seen so far, and just ahead of trend line resistance at 81.70. This is the bear trend line from 1927 high, and this keeps the currently the near-term bulls in play, and focusing a possible test of 83.95 and 84.75 ahead of 85, our key barrier on the upside. Failure to regain 84 zone, which are these two tops here, would risk a reversal and the resumption of the broader downtrend of the crude oil, and seen this recent strong bounce as a correction. So the basically only regain of $85 per barrel is to signal a stronger recovery of the crude oil and open levels towards 88 and $100 as our keys, and the 90, pardon, dollars as the key barrier at this leg lower. This is actually the high of 13th of September, as we can see it on the daily here. Basically, this is our top of the recent the medium-term rally from 75.70. However, the broader outlook remains firmly bearish, as the recent loss of previous support 75.70 extended to the levels below 75, and the latest move is seen corrective, as I mentioned, while holding below 85 resistance zone, and the likely scenario would be lower top somewhere under 85 and resumption of the downtrend from the technical point of view. Now we have to see how the things will be developing in the, especially in Eurozone and the US, as the direct influence from the current crisis is triggering increased fears of the reduction of the lowering demand for energies and pushing the oil price lower.